Today, Delta takes a toll. Market update for the 21st of August 2021. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. In today's show, we look at the market wrap and also consider the undercurrents ahead. Is the Delta variant starting to cast a larger shadow? And what might this mean for markets and central banks? Market participants continue to be faced with many uncertainties. Uncertainty about the timeline for future Federal Reserve changes in the monetary policy. Uncertainty about the length and damage the new Delta variant of COVID-19 has had on human lives and economic regrowth, and uncertainties surrounding the Taliban takeover in Afghanistan. And then, of course, we had the US consumer sentiment, which dropped sharply in early August to its lowest level in a decade, in a worrying sign for the economy as Americans gave faltering outlooks on everything from personal finances to inflation and employment. The entire premise of monetary policy is to spur consumer spending, yet despite the massive expansion of the Fed's balance sheet and the surge in asset prices, there was relatively little translation into wages, full-time employment, or corporate profits after tax, which ultimately triggered very little economic growth. In fact, over the past half-century, the sentiment index has only recorded larger losses in 6 other surveys, all connected to sudden negative changes in the economy. Richard Curtin, the chief economist for the University of Michigan's Surveys of Consumers, said in its release. 2 of those larger month-over-month movers were April 2020, amid the pandemic, and October 2008, during the financial crisis. The decline was extremely sharp. Not only was the release dramatically worse than the last update, but it was a huge miss relative to expectations. The release came in 11 points below expectations. The only other month going back to 1999 that even comes close was a 9.9-point miss in February 2004. In fact, the mainstream analysis missed that the correlation between confidence and markets actually broke down way back in 2019. Notably, while the Fed is engaged in monetizing $120 billion in debt monthly, higher asset prices isn't inflating confidence. Now, that's not what's meant to happen. And then, of course, there is Delta. A sharp example and close to home for the Fed is the fact that the Federal Reserve Bank of Kansas City said on Friday that its annual economic symposium in Jackson Hole, Wyoming, will take place on August the 27th, virtually and not in person as planned. That's the clearest sign yet of the impact of the COVID-19 Delta variant on the Fed's plans. While we're disappointed that health conditions will prevent us from being able to gather in person at the Jackson Lake Lodge this year, as we planned, the safety of our guests and the Teton County community is our priority, said Kansas City Fed President Esther George in a statement, citing the recently elevated COVID-19 health risk level in Teton County. Under the county's guidelines, people should not gather with non-family members or host in-person social activities. The reversal raises questions about the Fed's broader assessment of the Delta variant's economic impact, which Chair Jerome Powell and other policymakers have mostly played down, saying that businesses and households have learned to live with the virus. It certainly is going to be a communications challenge for Powell to stick to the view of only minor impact from the recent surge when he'll be giving his highly anticipated speech on the economic outlook to an online-only audience, said Yale School of Management's Stephen Kelly. Or, as Grant Thornton chief economist Diana Swank quipped on Twitter, I think the tenor of Powell's comments just shifted a bit on the economic outlook. At their meeting last week, Fed policymakers began coalescing around a plan to begin to reduce their support for the economy before the end of the year, as long as the labour market continued to improve as expected. The Delta variant, though, is raising questions about that. Earlier on Friday, Dallas Fed President Robert Kaplan, who backs a plan to start trimming the Fed's economy-boosting bond purchases by October, said it's already seeing some signs of the rising caseloads impacting hiring and would be watching it carefully in the run-up to the Fed's next meeting in September. The gathering was already going to be a muted affair. The guest list had been scaled back, with foreign central bankers not attending, many of the lodge facilities closed or limited, and masks mandatory outside of meals. Vaccines were required for all attendees and their families. Even as late on Friday afternoon, Fed policymakers still had been planning to attend, with their staffs pinning down details for meetings outside the scheduled events. The Fed said this week, however, that Powell would give his marquee speech remotely, and now everyone else will attend online as well. Sparsely populated Wyoming, on a per capita basis, have averaged 54 cases per 100,000 people in the last week, versus 43 per 100,000 for the country as a whole. And Teton County's rate is 62 per 100,000. While Fed officials remain convinced this wave will not derail the recovery, the pace of the virus's current surge is starting to be felt. Economists this week began trimming forecasts of economic growth, and while the cuts weren't dramatic in what is still a strong recovery, they marked a turn from the exuberance of the first half of the year. The impact of the Delta variant on growth and inflation is proving to be somewhat larger than we expected, Goldman Sachs wrote on Thursday, lowering projected 2021 growth to 6% from 6.4%. And high-frequency data showed the start of a possible slowdown in air travel and dining in restaurants. And Bank of America economists noted a recent decline in credit card spending on leisure, one of the business sectors hardest hit by the pandemic and struggling to re-employ its workforce. Yet Wall Street rallied to close sharply higher on Friday, closing a tumultuous week on easing concerns as to whether the US Federal Reserve could begin tightening its dovish monetary policy sooner than expected. While all three major US indices ended solidly green, all posted weekly losses after a steep midweek sell-off pulled the S&P 500 and Dow away from a string of record closing highs. Towards the beginning of the week, you saw traders balancing their books ahead of the Fed's statement, said Matthew Kelter, managing partner in the Kelter Group, a wealth management firm in Lenox, Massachusetts. And once the statement came out, you saw a bit of a sell the rumour by the news. Market-leading tech and tech-adjacent megacaps, which weathered the pandemic recession better than most, once again did provide the biggest lift. Growth stocks were also given a boost by US Treasury yields, which ended the week lower due to concerns the health crisis could be a longer than expected hindrance to economic revival. Announcements from a host of Asian nations that they were implementing drastic measures to curb the resurgence of COVID-19 due to the rise of the disease's highly contagious Delta variant put a dampener on stocks associated with economic re-engagement. Mixed economic data from the US and China suggests the ongoing recovery from the most abrupt recession on record has passed its peak and has lost some momentum. The Dow Jones Industrial Average rose 0.65% to 35,120. The S&P 500 gained 0.81% to 4,441, and the Nasdaq Composite added 1.19% to 14,714. All 11 major sectors of the S&P 500 ended the session higher, with tech stocks and utilities enjoying the largest percentage gains. Apple, Google parent Alphabet, Facebook and Microsoft all ended higher, with the latter more than 2% higher. Microsoft was boosted following news earlier this week that the tech giant will raise business subscription prices on its suite of Microsoft 365 products. The climb in big tech comes as other corners of the market, including cyclicals, are struggling to hold onto gains amid concerns about the impact of the Delta variant on economic growth. Chinese shares listed in the US rallied on Friday but still suffered their longest streak of weekly losses in a decade. Both the dollar and treasuries were little changed. US-listed shares of China-based tech-related companies oscillated market participants as they digested recent sell-off resulting from Beijing's ongoing regulatory crackdowns, which has wiped $500 billion from Chinese markets this week. Alibaba Holding Group closed down 1.6%, while Tencent Music Entertainment Group, Didi Global and IQI gained between 1.6 and 3.7%. In terms of good economic data yesterday, the US initial jobs claims finally managed to beat its forecast and came out at 348,000 against the 363,000 which had been initially expected. This kept slight positivity in the market, not allowing the US indices to sell off too much, but good news was not coming from the US continuing jobless claims indicator that came out at 2.82 million, showing a slight increase from the initially forecast 2.8 million. The fact is, there are still plenty of people continuing to claim unemployment benefits, and it seems that the country is struggling to get back to pre-pandemic numbers. Although those uncertainties continue to weigh heavily on the minds of market participants and support gold prices, gold has not been able to break above 1,800 US. After last week's dramatic sell-off and recovery in gold pricing, investors and traders in the precious yellow metal were able to move gold to a higher high, a higher low than last week, and an extremely fractionally higher close when compared to Monday's opening price. Gold futures, based on the most active December 2021 COMEX, opened on Monday at 1,780 and is currently trading down 40 cents and fixed at 1,782. Today the dollar traded to the highest intraday, hitting a high of 93.75, but the dollar index is still a little down. The dollar index traded to its highest closing value yesterday and ended the week with significant gains of just around 1%. To achieve the highest closing weekly value in 2021. That being said, the current value of the dollar index is far below the heights witnessed in March 2020, when the dollar traded at just above 103 during the week of March the 16th, 2020. Another factor in containing any major continuation of the last rally in gold is a reignited interest in cryptocurrencies such as Bitcoin and Ethereum. Bitcoin futures gained more than $2,000 in trading today, a net gain of 4.33%, with a single coin currently fixed at around 48,700. Ethereum gained 3.49% in value today, with a single coin currently fixed at around 3,265. Recent increases in the prices of these major cryptocurrencies has resulted in investors moving some of their speculative dollars out of the safe haven asset gold and into digital currency speculation. Financial markets were rattled this week by speculation the global recovery could lose momentum just as central banks get ready to reduce support measures. I mentioned that Dallas Federal Reserve President Robert Kaplan said he's open to adjusting his view that the Fed should start tapering its asset purchase program sooner rather than later if the Delta variant persists and hurts economic progress. While risks to the economy are mounting, money managers in search of returns are sticking to equities. US stock-funded data, collected before the Fed signalled it could potentially start tapering this year, showed investors have confidence in policy support to buy the dip, according to Bank of America strategists. While investors have understandably been worried about the Fed Reserve's potential tapering plans against the backdrop of persistent COVID-19 cases, we believe the Fed is unlikely to announce tapering plans until case counts fall back to early summer levels, said Rod DeLipsey, Managing Director at UBS Private Wealth Management. Now, during the European morning, Britain delivered its core and headline retail sales numbers for the month of July and on a month-on-month and year-on-year basis. Initially, the numbers were expected to decline from their previous readings, but the actual figures showed up even lower than their initial forecasts. For example, the core year-over-year figure was expected to appear somewhere around plus 5.7%, whereas the actual reading was just up 1.8%. The headline one was believed to appear around 6% higher, but showed up at 2.4% higher instead. The slowdown in retail was put down by the ONS to the combination of Euro 2020, which saw England reach the final of the tournament, and bad weather, keeping shoppers away from shops. Just don't mention the virus. But the pound did not react much to the news. European shares edged higher on Friday as Marks & Spencer lifted retailers, but the benchmark stock 600 still marked its worst week since February on signs of slowing economic growth and rising COVID-19 cases. The index slumped 1.5% on Thursday, just alone, tracking a fall on global equities on indications the US Federal Reserve could start reining in easy monetary policy later this year. Progress made by countries in dealing with COVID-19 still seems to have had little bearing, in general, on the relative performance of their stock market, said Bethany Beckett, US economist at Carroll Economics. Instead, swings in sentiment about the virus at a global level appear to have continued to exert a bigger influence via sector rotation. And Beckett thinks this is going to continue. Luxury goods rebounded from declines earlier in the day to gain 0.5%, but fell 5.5% over the week, pressurised by worries over possible wealth policy developments in China. The pan-European Stoxx 600 index was up 0.3%, with the retail sector gaining 1.2%. Marks & Spencer, the British retailer, jumped 14.1% to the top of the Stoxx 600 as it hiked its profit outlook after a jump in demand for food and a surge in online clothes orders indicated that its latest turnaround plan was starting to deliver. The FTSE rose 0.4%, while the DAX was up 0.3%. Frankfurt shares recovered from a fall earlier in the session after data showed a bigger than expected jump in producer prices in July. German factory prices soared 1.9% in July, up 10.4% on the year, and at a level that is likely to catch the attention of the European Central Bank. The mining index ended flat, becoming the worst performing European sector for the week. Elsewhere, oil prices stabilised on Friday near 3-month lows, but they're still heading for hefty weekly losses amid concerns about global demand growth as measures to tackle the Delta coronavirus variant hit mobility. Earlier on Friday, Chinese authorities passed a major data protection law along the lines of Europe's global data protection regulation, the latest in a series of moves that will hit the way the country's technology giants operate. And during the Asian session, we also received China's PBOC loan prime rate. There was no initial expectation, but the figure remained the same as previously at 3.85%. Last time the rate change was back in April 2020. The Shanghai was down 1.1% to 3,427. Drewry's Composite World Container Index continued to increase, marginally up by 2% this week, or $192 to reach 9,613 per 40-foot container. That's 360% higher than the same week in 2020. That's the 18th consecutive week of increases. Freight rates from Shanghai to Los Angeles soared 6% to reach 10,969. That's a change of 242% year over year. Drewry expects rates to increase further in the coming weeks. Here in Australia, the Australian share market extended its losing streak on Friday, dropping 3.7 points as a sell-off across commodity markets weighed on mining stocks. The ASX 200 ended the session down 0.05% to 7,460 and fell 2.2% over the week. Much of the move in commodity prices appears to be related to the economic outlook, said HSBC Chief Economist Paul Bloxham. The worst hit miners, including Linus, which dived 6.9% to 633, Pilbara Minerals 5.6% down to 202, and Ocobra 5.7% down to 866. Nickel mines fell 4.5% to 96.5 cents. Chalice Mining tumbled 3% to 626. Newcrest Mining dipped 3.3% to 24.71. South 32 dropped 3.1% to 278, and Oz Minerals declined 2.8% to 2092. BHP extended its decline, dropping 0.7% to 44.34, but Fortescue climbed 1.1% to 20.36, and Rio Tinto edged 0.1% higher to 107.23, despite the iron ore price plunging nearly 15%. Earlier in the week, BHP had warned of peak iron ore prices amid China's declining steel production and the latest COVID-19 outbreak. Medium-term, China's demand for iron ore is expected to be lower than it is today as crude steel production plateaus and the scrap-to-steel ratio rises, BHP said in its outlook on commodities. The recent rise in iron ore prices since the pandemic began in early 2020 came to a screeching halt in mid-May when regulators began to wage war against soaring commodity prices. The high cost of iron ore and other raw materials raised concerns about producer price inflation, prompting Beijing to act. The South China Morning Post said that by the third week of July, Beijing unofficially told steel producers in various provinces to limit this year's output to that of last year's. And China's Ministry of Finance has also removed export tax rebates on 23 steel products, a move to discourage steel exports. China Iron Ore and Steel Association President Shen Bin also got in the action with a sucker punch to prices by vowing to accelerate and ensure China's self-sufficiency in iron ore supply. By August, steel mills in steelmaking hub Tangshan were told by the government to reduce capacity to fight pollution. ING commodity strategist Warren Patterson and Wang Yao recently wrote in a note to clients. And S&P Global forecasts that China's construction steel demand will likely plunge in the second half of this year for the first time in 6 years. Copper prices also eased to the lowest point in a month after the global economy appears to be on shaky ground. Even Goldman Sachs analysts are saying this is not good. Travel stocks also struggled as Sydney's lockdown was extended by 1 month. Corporate travel management fell 3.3% to 21.10. Flight Centre dropped 2.3% to 13.74 and Qantas tumbled 2.1% to 4.25. Sydney Airport dipped 0.3% to 7.70 on its half-year results. Cochlear was the session's biggest laggard, plummeting 7.4% to 237.05 after falling short of profit expectations. And Redbubble led Friday's gains, surging 15.7% to 421 the day after reporting record earnings for the 2021 financial year. Fellow e-commerce player Kogan climbed 4.3% to 13.02, and poultry farmer Ingham's added 4.6% to 4.09 after announcing that its statutory profit doubled to $83.3 million for the year. The company rewarded shareholders by increasing its total dividends by 17.9% to 16.5 cents per share. And so standing back, you can certainly see some of the cross-currents. We know that the Delta variant is continuing to spread, and that's going to worry many investors as they get to understand the implications. But I think the iron ore price is very significant, specifically in the Australian context. And given the fact that our lockdowns are continuing, that consumer confidence here is easing, and we also know that the unemployment rate is a lot higher than the official number, as I discussed yesterday. So there are many signs, I think, of more uncertainty ahead. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.